The IRS just opened a 90-day window to settle, and after that, it's 40% penalties and a nearly total deduction wipeout. If you or any of your clients touched a syndicated conservation easement, this episode could be the most important thing you listen to all year. My guest spent 20 years inside the IRS running the actual conservation easement enforcement campaign. She's seen both sides of the table. What she's about to tell you will either save you a fortune or confirm you need to pick up the phone today.
Welcome to the Tax Strategy Playbook, the show where smart investors, business owners, and real estate pros learn how to win the game the IRS wrote. Each episode, we break down powerful strategies, expert insights, and real-world examples that help you keep more of what you earn. Because here, it's not about working harder, it's about working smarter with your taxes, because tax evasion is a crime, but tax avoidance is mandatory.
Welcome back to the Tax Strategy Playbook, the show where we break down the strategies that real estate investors and businesses use to legally keep more of what they earn. I'm your host, David Weiner, Mr. Cashflow, founder of Cashflow Strategies. And if you're a real estate investor, business owner, or the advisor who serves them, you're in the right place today. Today, we're going to go deep on one of the most scrutinized and most misunderstood tax strategies in the entire IRS playbook, conservation easements. The IRS has over 1,100 open cases right now. Tax courts has been issuing opinion after opinion, slashing deductions by 97% or more and hitting taxpayers with 40% gross valuation misstatement penalties. And as of May 13th, the IRS has opened what they're calling a final time-limited settlement window for eligible taxpayers. 90 days to settle or face the courts. There's no better time to understand exactly what's legitimate, what's abusive, and what your options are if you're already in the crosshairs. So stay with us. My guest today brings something almost nobody in the private sector can offer. She was on the inside building the enforcement machine. Victoria Boone is a former IRS senior revenue agent and subject matter expert for the IRS Large Business and International Division, where she spent more than 20 years. She worked directly on the conservation easement and aircraft compliance campaigns, helped develop the national training for IRS agents, and co-authored updates to core IRS publications and forms, including Form 8824 for like-kind exchanges. Today, she's the founder of Boone Tax Educators, where she provides continuing education to CPAs and enrolled agents, and she serves as the Director of Tax Representation Strategy at Boone Tax Group, where she advises clients on audit defense, IRS representation, and pre-audit strategy. Victoria doesn't just understand how the IRS thinks, she helped shape it. Victoria, I've been really excited to have you on the show. Welcome to the Tax Strategy Playbook.
Well, thanks for having me. It's exciting to be here and share my knowledge and hopefully provide some insight that will be helpful for others.
Thank you. For listeners who've heard the term, but they're not sure exactly what a conservation easement actually is, walk us through the basics. What was the original purpose of this deduction, and how does it work when it's done correctly?
So what a conservation easement is, it is you keep the ownership of a property, but you say, okay, I'm not going to develop it. I'm going to conserve this property for the use of recreation or other activities. It's not going to be built on. There's not going to be any kind of development on that activity. So it's restricting the use of the land. And in doing so, it's preserving wildlife. It would preserve just green areas and spaces.
Which is really important.
Yes, it is. It's definitely important. It's very responsible, right? It's a responsible way for the government to say, okay, we can't just build everything up. We need to give back and preserve what we have and use our natural resources in a
And
way
that's a good thing.
productive. Yeah.
Now, on this show, we talk a lot about legitimate accelerated depreciation strategies. Cost segregation is my world. I'm a cost segregation provider. And I think a lot of real estate investors hear conservation easement, and they put it in the same bucket as bonus depreciation, a legal IRS recognized tool. So where does the legitimate conservation easement end and the tax shelter begin? What are the hallmarks of a properly structured, defensible transaction versus one that's been engineered purely to generate a deduction?
think it really just comes down to documentation, documentation, documentation.
Like
What can
everything
you
else.
support? Exactly. It comes down to, okay, well, here is, the IRS is looking mainly at valuation, right? They're not, that's what's flagging things. Okay, you have this huge donation. It might be valid, it might not be valid, but because there's a huge amount there, they're targeting that and they're looking at it and they're saying, okay, was this allowable and was it not? And a lot of the times when I was working in the conservation easement campaign, it wasn't because things didn't fail because there wasn't a donation. It failed because they didn't have the right documentation. They didn't fill out this form properly. They didn't, kind of fill in the blanks. But 170 has very, very strict substantiation requirements. And in fact, I've been teaching courses on this on my platform and other platforms. And it's so strict. And that's what a lot of times throws people out. And that's why the courts, you had mentioned, the percentage of court cases that are being upheld for the IRS's position, and that's because of the strict substantiation. And the judges even mentioned it in some of the cases. That, well, I'm sorry, my hands are tied. I can't do anything. This isn't right. But the law is you either check the box or you didn't check the box.
You worked inside LB&I at the IRS during the rise of syndicated conservation easements. What were you seeing on the government side that told you this had become a problem?
You can see just the pattern of the large adjustments, the large amounts of deductions. And then you would look into them further and you would see, okay, well, this isn't done right and that isn't done right. And I helped create checklists for the IRS of, okay, go down the list, here's the form for the charitable contribution. Here is how it relates to the code sections. If there's something missing on this form, go back to the code section. A colleague of mine often refers to it as the death trap. It's the death trap. It's where conservation easements and any charitable deductions die if it's not filled out properly. And that's in addition to the CWAs.
And what strikes me from what I've been reading and what I've been hearing is that the abuse wasn't subtle. It was brazen. And yet investors kept pouring money into syndicated conservation easements because the promised deductions were so large. And we'll get into exactly what the IRS is doing about it right now and what the numbers look like in court. But first, before we go any further, if this is something that you're getting value out of right now, don't touch that dial. What Victoria is about to share in the next segment is the stuff that most CPAs and financial advisors still don't fully understand, and it directly affects you or your client's exposure right now. So stay locked in. The IRS just announced a new time-limited settlement program on May 13th. It was IRS 2026-65. Reportedly, over 1,100 open cases, including 740 of them currently in tax court. Walk us through what the settlement offer actually says, the 90-day window, the 10% penalty tier, the 20% tier, and why Treasury is calling this the final push.
Well, I'll start off with why they're calling it the final push. And that's
Okay.
because they have offered multiple settlement options. They've gone through this process multiple times. They've offered this, and I don't know if it'll actually be the final one, but it's their way of saying, look, we've done this over and over and over and over again. We've given you
Take
so
care of
many
this.
opportunities. Like, come on, let's take care of this and let's free up the tax court. Let's, settle these cases, free up the resources at the IRS and move on, right? I mean, that's the whole point of this. That's why it's the final offer.
Have most of the problems wound up being in the syndicated conservation easements?
I mean, there's a whole campaign just for the syndicated conservation easements.
Because syndicators tend to overstate the deductions.
Right. I mean, that's really what the whole campaign boils down to is the valuation. When I was at the IRS, initially it was, we're just going to go down the 170 checkbook, right? We're going to go through and we're going to say, you don't have this, you don't have that, you don't have this, you don't have that, you don't get the deduction, right? We're just going to throw it out from that. But recently you can see that the courts have started addressing the valuation side. They've started addressing the appraisers and all the valuation aspects of it. So given that background, it doesn't make sense to continue on with something that's overvalued. I mean, look, the IRS already and Congress already passed Treasury regulations specific to conservation easements because of the because of all of the abuse. They're saying,
So this is
okay,
not
we're
a
gonna
new problem.
no. I mean, they came in and they said, okay, we have this campaign and we're doing all this stuff about it. And so they issue the regulations and they say, okay, well, we're going to limit it and this will be better. But they're still finding issues. So they're still finding issues, and there's still deductions out there. I mean, the campaign goes in and it reads things on the tax return, right? It's looking for all of the charitable deductions and seeing what it is. It can read that stuff. It reads the 10Ks. It reads all of this information and it puts it together and says, okay, based on this, you know, here's a kind of like a list of cases, you know, a bunch of people that might have some issues. So I guess maybe this is a good idea to just go through the process of how this works. So after they identify a whole bunch of potential cases, they then have someone go in and review it and say, okay, is this issue present? Is it not present? And the reviewer will go in and they'll classify it and say, yes, it's present. No, it's not present. And then it will be sent out to someone to audit it. And when it's sent out to audit, there's a whole list of stuff. It says, you must look at X, Y, and Z. It'll say for conservation easements for example, it'll say, hey, look, you need to look at conservation easements. Here's all the information we have on it. Here is checklists that you need to go through. Here's lead sheets. Here's everything you need to do. You have to do this, and it's required. So there is a process that it goes through. It's not that the IRS is just saying, oh, we're
just going to
if they
jam the people.
right. I mean, they're sitting here going, okay, well, we're still seeing these big deductions, and if we're still seeing the big deductions, we're going to look at them, and if we're still having trouble with the deductions, we're going to continue on. So they were
And
hoping that having the regulations out there would help with that, and unfortunately, it hasn't. And so they're going, okay, well, let's continue on then. And it's not going anywhere.
absolutely. And while we're talking about the abuses and those kinds of things, I don't want to scare people off. Conservation easements are legitimate if they're done properly, right?
They are. Yes,
Okay.
they are definitely.
Because I've
yeah.
seen tax court opinions in a couple of cases like Jackson Stone South and Beaver Dam Creek Holdings, where deductions were slashed by 97% or more, and 40% gross valuation misstatement penalties were upheld. And you think this is mostly in the appraisals or the structure or the intent or all three?
So a lot of these disallowances are due to the strict substantiation rules of 170. That's why it's really, if you're going to get into a conservation easement and you're going to go down that path, it's definitely a viable path to go down. But you want to make sure that you have someone that specializes in that area, whether it be me or someone else. Someone that really specializes in making sure that all of the boxes are checked, because otherwise you end up losing the deduction. And I don't remember what court cases have come out recently, but some of the judges have said, man, I wish I could do more, but my hands are tied. There is a valid transfer. There's a valid charitable interest. Everything is valid, but you didn't check the boxes. And because you didn't check the boxes, I have no wiggle room. My hands are tied.
Isn't that a
And so
shame?
it is, and that's exactly, there are too many. It's not just one little, either you have this or you don't. No, it's you have to have this and this and this and this. You have to have charitable intent. You have to have an actual interest that was transferred. You have to have appraisal attached. You have to have the form filled out properly. You have to, you know what I mean? Like, it's just ads and
Absolutely.
ads and ads. It's not like a colleague of mine kind of explained it as kind of a Christmas tree, right? You have a tree and then there's some lights you put on it, and then there's some ornaments, and then you go on a trip and you have some more items that you put on the tree, and then you go in and you add, your kids come along and they add items. Nothing gets taken away, but all of a sudden you look at your tree and you're like, that's really great, but where did all this stuff come from? Right? I mean, if I had to
Exactly.
recreate that, that'd be insane. So,
And
um,
Treasury's also said that the IRS is also ramping up scrutiny on historic preservation easements with improper valuation. For somebody who's sitting at home right now who participated in one of these deals 5 or 6 years ago, what do they need to do?
Well, if it was 5 or 6 years ago, they're probably okay because the IRS has a 3-year limitation to audit returns,
Okay,
and it's
good.
3 years from when it's due or from when it was filed. But for a lot of this is just going through and making sure you have the documentation. Some of the stuff you can recreate and some of the stuff you can't, like a CWA, for example. Can't necessarily be recreated, but there are things that you can do to corroborate anything that's missing on it, if that makes sense. So you can't say, okay, I'm just going to create a new CWA and I'm all good and I'm going to get upheld in the audit. That's not going to happen. But if you do have other documentation that corroborates it, right? It doesn't have to be a specific form that's filled out, unlike, other things. You can piece together other information. You can piece together board meeting minutes or different things like that that can piece that together. So if you're involved in that, it really gets into making sure that you have a substantiation. Find a way to figure out, consult with someone, right? You're going to want to consult with someone that says, hey, let's look at this. Let's make sure that you have all the documentation. If you don't, let's look into it and dig into it.
Is there something like a checklist that somebody could look at to kind of go through and make sure that they've done everything right?
I'm
Or do
not
they really
aware
need
of
to work with somebody who can walk them through it?
I would really highly suggest having someone walk them through it if they're really concerned. You can go and look at the IRC 170 rules. They are very strict. There's a lot of them. It would say if you want some reading material right before bed and can't fall asleep, you're welcome to do that. But also you can look at the publications is what I would really suggest, is because the publications really do provide a lot of good material on what you need to do. It's written in plain language, it's updated, make sure it's the most recent one so it's most updated. And read through those publications and also through the instructions. Cuz the instructions will say, "Hey, put this on this line or leave this blank if this is the case." So that was really, if you don't want to consult with someone, go through the publications, go through the instructions. They're really informative. They're written at, I think when we were told to write them at like a maybe high school grade level. So they're not legalese. They're easy to understand. So that would be my biggest
That's
suggestion there.
great. It seems very similar to what I tell my clients a lot of times. If you have insomnia, get the get the IRS audit guide on cost segregation and just read through that. And it's the same kind of thing. You can't go back and you can't recreate your time logs for real estate professional status. You can't go back and recreate your time logs for material participation. You have to have it, and if
Right.
if it's ever called into question, you got to have it. So let's get into in a minute, what do you do when the IRS actually comes knocking? But let me ask the listeners to do something real quick. If this is hitting different for you, I need a favor. Hit the subscribe button right now wherever you're listening. Apple, Spotify, YouTube. It literally takes 2 seconds and it means the world to this show. And if you're watching on YouTube, drop a like while you're at it. We bring guests like Victoria on specifically because they have the information that can change your financial life. The least we ask is that you help us get in front of more people. Okay, so let's get back into it. And Victoria's contact information will be in the show notes for this. If you need to contact her or want to contact her for more information or for somebody to actually walk you through the process, you'll be able to do that as well. So you now advise clients on audit defense at Boone Tax Group. When a client comes to you and says, okay, I claimed a conservation easement deduction and I just got an IRS notice, what are the first 3 things you look at to assess their exposure?
Well, I definitely want to look at the CWA. I want to look at the
And
the
for somebody
form.
who's not that familiar, what exactly is a CWA?
CWA is contemporary written acknowledgement, and it's provided from the charity, and that's what is used. It is one of the strict requirements in the conservation easement, or for anything actually, for charitable contributions is required.
Okay. That's the
So
first
that's
thing. What else would you look at?
the 8283, and making sure that that's filled out properly, what's on it, and then also what other any other documentation related to it, right? So if it's property, if it's a conservation easement, there's property, look at the sales document, look at the deed, all of that kind of background information that really starts to paint a picture.
You also teach CPAs and enrolled agents through Boone Tax Educators, right? Including courses specifically on how the IRS evaluates charitable contribution appraisals and conservation easements. What are the most dangerous assumptions tax professionals make when they see these deals come across their desk that aren't experts in it like you are?
The main issue is that they think that, well, I have this form, the 8283, that's sufficient. I don't need a CWA. Or they think that, oh, well, there was intent, right? I mean, I can just prove things. It like they just assume that something similar to the Cohan rule would apply, that I can just paint a picture and based on the painted picture, the auditor will just allow it. And that's not the case because the rules are so strict and they're so.
The auditors, I would assume, don't have that kind of discretion.
No, they don't. That's the problem. I mean, even the auditors get to the point where they're like, I'm sorry, I can't help you. They're similar to the judges that we were talking about. They're going, I want to give you the deduction. I can see that you gave something to charity and the charity benefited from it and you wanted to do this. It's not like there was quid pro quo, like I scratch your back, you scratch mine going on, but I can't do it because you didn't meet the requirements. You didn't check off all the boxes. You didn't do that. So the auditors are human too. They feel they don't want to. Sometimes the auditors get a bad rap, thinking that they just want to just disallow everything. They're mean and horrible. And when I was at the IRS, just mentioning that you were an IRS auditor would just shut down conversations because people are like, I don't want to talk to you. But that's not the case. They're just human and they are doing their job. And
I
when the
spoke
code section is strict, it puts them in the same predicament that their hands are tied. They can't do anything.
I spoke one time for a group of retired revenue agents, and they introduced themselves as the most hated people in America.
Luckily, since I've left, people have had a bit of the opposite reaction. They're like, wait, you worked at the IRS? Like, how does that work? What's going on?
You're just like a real person.
Right. They're shocked that I'm just a real person. And I'm going, okay, yeah, all right.
I've met a lot of people who used to work for the IRS, and I've had guests on the show that used to work for the IRS, and they seem like real normal people. But
they are. And I will say that on Boone Tax Educators, the platform that I have, all of the people that teach classes are former IRS. And so you can see that over and over and over again through all of the different classes that we're teaching, is that it's all just normal people that are very knowledgeable in their specific area.
Who are doing the job.
Yep.
So from what I'm hearing, a qualified conservation easement contribution today can be very legitimate. And I'm assuming that the ones that could actually survive the IRS scrutiny just are the people who worked with an advisor, made sure they checked all the boxes and went through it in the proper way. Is that pretty accurate?
Pretty much. Yeah, that's definitely accurate.
That's exactly what I want people to walk away with today. There is a right way and there is a wrong way. And the difference between them is documentation, an actual credible valuation, and then working with somebody who actually knows what survives an audit. So let's bring this whole discussion home with some rapid fire takeaways so our listeners have a clear action plan. So if a listener's client or a listener is sitting in a syndicated conservation easement deal right now and hasn't been contacted by the IRS yet, should they wait or should they proactively reach out to get ahead of it?
That's really up to them. It's I kind of call it the audit lottery, right? You want to, how risky do you want to be? Do you want to risk an audit or do you want to just take care of it and have peace of mind? And so that really comes down to how much risk aversion do you have? Do you want to go ahead and clear everything up, be proactive, take care of it, then go ahead and do it. If you're already in the pipeline, definitely you have to be a little bit more than proactive, right? I mean, you've already been contacted. You know what the consequences are. You know where the path is eventually leading. So There's a bit of a different approach of, I would definitely know that there is a possibility of an exam, and if you are examined, there's a higher than normal possibility of being examined because there is a campaign on this. And if
Just
you
like
know
somebody who
that,
claims real estate professional status.
right, there's definitely, and I would say even more so than those that claim real estate professional status, because the IRS is actively looking for, there's not a box on the 1040 that says I'm a real estate professional, right?
Right.
But there is a box, there's a whole form that says, "Hey, I contributed something to charity." Well, the IRS is looking at that, and they have transcribed that recently so that everything is all comes up and is easily searchable. They're looking at that.
And
So
I'm
when
assuming
you're
if they're gonna reach out, if they don't just wait to see if they get contacted, if they're gonna reach out, they're gonna reach out to somebody like you
I yeah,
to
I
to
definitely,
review.
yeah, review it and just see, okay, is this okay? Is it not okay? Is there something I need to worry about? Even if you don't proactively go take the settlement or do different things like that, just having peace of mind of knowing, hey, even if I'm audited, this is going to be upheld, or high
Sure.
likelihood of it being upheld.
That's
So,
that's good to know.
yeah. The IRS is also doing a lot with matching, right? So the 8283 and then the 8282 is being matched up if it's filed. So the 8282 is what's filed on the nonprofit side, and the IRS is starting to match those up. And sometimes that may happen a couple years later, and that may also trigger an audit. So just know that also is another way that not only is there a campaign, but they're also doing matching. They're doing more and more of the focus in on how can they easily match numbers and send out audits and letters and things like that.
I kind of get the feeling like when you file your taxes, the IRS already knows all that information. So they're just seeing if you tell the truth.
I always say that filing a tax return is the first step in negotiating with the IRS.
They already know.
A lot of the things they do already know. There are things that they don't know, and they don't know facts and circumstances, and a lot of times that's exactly what matters. But
Sure.
they are going to be able to match up numbers, and then when they match up numbers, they're going to say, "Hey, something's not quite right here. Let's go ahead and back up, and let's send you an audit notice or a letter like CP 2000 saying something doesn't match. Something's not quite right."
I'd rather get that CP 2000 than an audit letter. But what's the single biggest misconception, if you know one, you hear from real estate investors about conservation easements?
Aware of any specific myth, but it
Or
kind of
just
falls
where
into
they don't
two.
understand it?
I think they just don't understand the documentation requirements, that there are specific requirements that have to be met or the whole donation goes away. It's not that, okay, we're going to adjust the value of the donation. No, it's like you don't do this, you get zero. It's either you get the full amount or you get zero. There's no gray area, there's no in between. It's 0 or 100. And that really is what a lot of people don't realize is that, okay, if something goes wrong, it's all gone. It's not that there's some kind of wiggle room in the middle. There's not negotiating on amounts. It's just completely all gone.
Yeah, it's win or lose.
Yes.
So where can people find your courses, follow your work, get in touch with you if they need help?
You can find me at www.boone.tax. And you can also, and that has all the consulting and things like that you can contact me with. And also Boone Tax Educators is www.boontaxeducators.com. And you can find all of our courses there. We just recently did one on not only charitable deductions, but also appraisals. So those will be up on our website soon for self-study. And you can
Excellent.
contact us through that, or you can email me, victoria@boone.tax. Again, remember, no E's in Boone.
And like I said, Victoria's contact information will be in the show notes at taxstrategyplaybook.com. I can't thank you enough, Victoria. This is the kind of episode I wish existed when some of my clients were first asking me about these structures, because I have people contact me and say, all I have is a piece of land. What can I do? And I can't do cost segregation on a piece of land. And so they said, well, there's got to be something I can do. the fact that you were literally inside the IRS building these campaigns, and now you're kind of on the other side helping people navigate the aftermath of these things, that perspective is invaluable. So thanks so much for joining us.
Thank you for having me. It's been great.
Listeners, the IRS settlement window is open right now, and it will not stay open. If anything Victoria said landed for you today, don't sit on it. Reach out to a qualified tax representative who understands the conservation easement space. And here's what I want from you this week. Go leave us a review on Apple Podcasts or Spotify or YouTube and tell us, are you or someone you know sitting on one of these deals right now? What's your situation? You can also find us again on YouTube and drop your question in the comments. I read every one of them. I'll respond to them. If you want a direct conversation, shoot me a message on LinkedIn. We may even do a follow-up episode answering your questions with Victoria if we get some good questions. So make some noise. Let us know that this topic matters to you. And if the episode gave you value, please subscribe. Share it with a real estate investor or advisor who needs to hear this. And we'll see you on the next episode of the Tax Strategy Playbook.
Thanks for listening to the Tax Strategy Playbook. If you found today's strategies valuable, be sure to subscribe, leave a review, and share the show with someone who wants to play smarter with their money. You'll find more resources, tools, and expert tips at taxstrategyplaybook.com. After all, it's your money. Keep more of it.